Welcome to this explainer. Today we're tackling something that I think a lot of us ignore, the silent, hidden costs quietly eating away at your long-term wealth. If you've ever stared at a mutual fund statement and thought, wait, what am I actually paying for this privilege? Well, you're in exactly the right place. We're going to break down a concept that sounds super technical, but trust me, it's actually incredibly simple once you look under the hood.
Okay, let's kick things off with a bit of a financial mystery. Picture this. You and a friend both invest 1 lakh rupees. You pick mutual fund A and your friend goes with mutual fund B. Now, fast forward 2 decades. You both finally log in to check your accounts. Both of these funds invested in basically the exact same companies. Both earned almost the exact same market returns. And yet, after 20 long years, your friend somehow has lakhs of rupees more than you do. Right? It completely forces us to ask, how is that even possible? I mean, neither of you invested a single rupee more than the other. Neither of you took on any extra risk. You literally just let the money sit there and do its thing. So what on earth caused such a massive gap in your final payouts? Well, the secret, that massive discrepancy, it literally all comes down to just one small, totally overlooked detail: the expense ratio. Yup. The expense ratio. Think of it as the silent engine constantly running in the background of every single mutual fund you own.
To really get this, let's think about a school bus picking up hundreds of kids. To actually keep that bus running on time, someone has to pay the driver, they have to buy the fuel, cover the insurance, handle repairs. You get the idea, right? Without paying for those crucial things, the bus simply isn't going anywhere. Well, a mutual fund is exactly the same. It needs professional fund managers, research analysts to pick the absolute best stocks, expensive trading platforms, and customer support teams. The fund has to pay for all of these operational costs somehow. And those operational costs, they're collected through one very simple metric. In the absolute most basic terms, the expense ratio is just the annual fee charged by a mutual fund to manage your money. It's basically the cost of keeping the fund's bus on the road. Or, think of it like ordering a delicious 1,000 rupee pizza. Before the restaurant even brings it out to your table, they take a tiny, say, 20 rupee service fee to pay the chef and the waiter. You still get your pizza, but you've effectively paid just a tiny bit extra for the privilege of having it prepared for you. If your investment grows, the mutual fund just takes their small slice for managing it. But, and here is the really sneaky catch, you never actually sit down and write a check for this fee. It is automatically deducted straight from the fund's assets, and it's reflected in the daily NAV. This is exactly why so many smart investors completely forget it even exists. You're never going to get a bill in the mail asking for 500 rupees to cover your fund manager's time. It's just quietly skimmed right off the top before you ever even see your returns. So let's look at how this actually plays out over a single year with a 1 lakh rupee investment. If the market gives you a really solid 12% return, a fund with zero expenses would grow to exactly 1,12,000 rupees. But if that fund has a 1% expense ratio, the return you actually get in your pocket drops. That management fee gets carved right out of your hard-earned gains. Now, I know what you're thinking. A single year? That doesn't seem like a huge deal. But let's zoom out. Let's set up a decades-long showdown between two highly disciplined investors, Rahul and Priya. They both do everything right, investing 10,000 rupees every single month for 25 long years. The only difference here, Rahul found a fund with an expense ratio of 0.2%, while Priya chose a fund charging 1.2%. That's just a 1% difference. Well, the result is absolutely staggering. This is the sheer power of long-term compounding in action. Even if both funds earn the exact same gross market returns, Rahul walks away with massive amounts of extra wealth. Why? Because less of his money is being siphoned off every single year to pay for the fund's bus. More of his money stays invested, and that saved money compounds upon itself year after year after year. Tiny, seemingly insignificant costs multiplied over decades make an unbelievable difference to your final wealth. Okay, but hold on a second. Before you run out right now and blindly search for the absolute lowest fee possible, consider this. Is the cheapest doctor always the best choice for your health? Imagine you have a really serious medical issue, right? One expert specialist charges 700 rupees, while another doctor charges 300. You wouldn't just automatically pick the cheaper one to save a few bucks, would you? Exactly. And the same absolutely goes for your money. A slightly higher fee can actually be a total bargain if the fund is expertly managed. You have to step back and look at the big picture. Does this fund actually align with your specific financial goals and your risk tolerance? What is the fund manager's actual track record like over the long haul? Are they buying high-quality assets? What's your investment horizon? Sometimes paying a tiny bit extra for a top-tier management team is honestly incredibly worth it.
Which brings us to a really crucial choice that every single investor faces: direct versus regular plans. Now, a direct plan completely cuts out the middleman. There are no distributor commissions, which means you get that much lower expense ratio. But it is a completely do-it-yourself path. You're on your own. A regular plan, on the other hand, has a higher expense ratio because it pays a distributor. But look, if you need someone to help research funds, review your portfolio, and frankly, keep you from panic selling when the market inevitably drops, having an AMFI-registered distributor by your side might easily justify that slightly higher cost. It really comes down to what you personally need as an investor.
All right, let's do a quick recap so we've got this financial mystery totally mastered. Number 1, the expense ratio is simply the annual cost of keeping your fund running. 2, you don't pay it out of pocket, it's quietly deducted from the daily NAV. 3, a lower ratio generally means more of your money stays invested to compound over the long haul. And 4, the golden rule: never pick a fund just because it's cheap. Overall suitability for your goals is always king.
Now, as we wrap up, please keep in mind this explainer is strictly for educational purposes. Mutual fund investments are subject to market risks, so you should always base decisions on your own unique goals or, consult a financial professional before diving in. I want to leave you with this one final thought today. Now that you've seen the absolute sheer power of compounding and exactly how a tiny 1% fee can literally eat away at your long-term dreams, how are you going to review your own portfolio today? Taking just a few minutes to look a little closer under the hood of your investments might honestly be the most profitable review you ever do. Thank you so much for joining me for this explainer. And hey, keep asking great questions about your money.